There is one asset that has a very high probability for a big expansion to the upside in the aftermarket DR session if you get a DR long confirmation between 8:30 and 9:30 p.m., and I will prove it to you with historical data in this new episode of the top 7 trades from last week. Number 7, Euro versus the Australian dollar, Monday aftermarket DR session. Euro AUD starts the new trading week with a banger in the aftermarket DR session. A green ADR box followed by a long confirmation in the first 30 minutes after the DR box has formed. Price rejects the IDR high combined with the closing price several times, and latest here you should be in a trade. Now pay close attention. The 1 SD level is obviously a good target for this trade, but the risk to reward is too low here. What if I tell you that you can expect with a high probability much larger moves in the aftermarket DR session when you get a confirmation in the first hour after the ADR box has formed? What about 2 SD or even 3 SD? Let's have a look at what historical data tells us for this example here in the Monday's ADR. If we filter the Euro-Australian dollar for this exact scenario, we get great insights of what the algo has done in the past. 50% of the time price reached 3.3 standard deviation. 2 retracement clusters inside the DR, and sometimes price retraced even below the DR, which would result in a false day. Time-wise, most retracements happened in the first hour and especially between 9:15 to 9:30 p.m., which is the retracement mode. 50% of retracements are done at 10:10 p.m. This is what we would get on our chart. The 2 SD as a target is literally a low-hanging fruit target. The red boxes are our time and price retracement clusters, and the darker ones is the time mode where most retracements have happened in the past. With the 9:25 candle closing at 9:30 p.m., the time mode ends and we can look for a high probability trade. Stop goes 2 to 3 pips below the retracement, and that's it. Very nice and clear trade setup where you could have banked 3R even without data on it. Now imagine the first setup would have failed. This could have been the second trade setup with even more confluences. The previous RDR high lines up with the second retracement box and the retirement setup area. Before I continue, I would really appreciate some feedback. Leave a like or a comment and let me know if you enjoy these kind of videos and want more. Number 6, S&P 500 futures market, Wednesday regular DR session trade. The trading day starts with the ADR being a false DR session, then continued by the ODR session, which confirmed shorts with a red DR box and getting nowhere near towards the ADR levels. Price drops lower in the ODR after a beautiful retirement setup, and we're opening the RDR session below the ODR. These are already early signs of a potential downside DR model coming into play. We get a large red RDR box and 20 minutes later a short confirmation. Price retraces a little bit but fails to close above the IDR low. Do you notice anything else? A double whip right at the IDR low here. Looks very interesting to me for a potential short setup. The next 5-minute candle closes outside of the DR, and at this point you ideally don't want to see price go above the IDR low again and place your trade with the stops above the retracement high, targeting the 1 SD level. If this setup would have failed, there would be another great opportunity with one open whip inside the range close to the IDR mid. Number 5, Euro versus the US dollar, Wednesday regular DR session trade. To the right you have the Forex pair Euro versus US dollar, and to the left the currency's futures market. Like I've already said in a previous video, you will miss out on important things like intraday gap imbalances or volume imbalances in the spot market price chart. Here again is a beautiful example of how you might have missed an important detail for this trade setup if you didn't look at the futures chart of Euro. The RDR printed a green DR box but confirmed short 20 minutes after its formation. It came back above the opening price to the minus 0.3 retracement level, but immediately found its way below the DR again. There's your first detail. In the futures chart to the left you have a double whip rejection, while you don't see that in the spot market price chart to the right. At 1 p.m. price finds its way to the IDR low for a potential short setup. Not only it's rejecting the IDR low, but we also have 2 previous whips lining up here and can target the 1 SD level with a high probability since it's the next SD level, and also an open magnetic whip lines up perfectly. Entry at the next candle's open, stops above the opening price, and let's go. Let's continue with number 4, Nasdaq 100 Futures Market, Friday aftermarket DR session trade. Nasdaq starts the Friday with the ADR inside the previous day's RDR. I call this the range contraction model, where price gets squeezed into one direction before it turns around. This is what I already explained in a lot of live session videos, which are free to watch here on my YouTube channel. I will put a link in the description below. Do you remember what I've said in my last video? Whenever you trade the aftermarket DR session, check if there is a daily gap imbalance. It is pretty obvious that is supporting price so far to the upside. Right here we get our long confirmation for the ADR session with also a green DR box, and can look for longs with a higher probability. With the long confirmation happening, you can already check things like open magnetic volume imbalances inside the defining range, but also the ones to the upside for potential targets. There is not a single one inside the range, but 2 right above us from the previous day's RDR. Price returns back to the IDR high and rejects it while leaving an open whip behind. That's your potential entry here, with the stops either aggressive 2 ticks below the IDR high or a little bit safer right below the closing price. As targets you have the next SD level of 1, but also 2 open magnetic whips where you can also trail your stop towards. As the highest potential targets, I would definitely also consider the RDR highs, because we are in a range contraction model. At this point the session comes to an end and you should definitely reduce your risk towards break even. Now right here all depends on your filling price. Price retraced almost back to the DR high and the session ends. Either you're still in your position here or stopped out break even. If you are still in the trade, wait for the opening of the ODR session. If the opening is above the ADR, it would already be positive for your position and you can wait for the DR box to form. If it is closing as a green DR box, we already have higher probabilities for a long confirmation and can trail the position even higher, with the stop now going below the green ODR box, because we don't want to see a short confirmation here. You don't always have to get this greedy, but in this example, if you understand the basics of DR models, you know with a high probability that price will be squeezed into one direction here. Finally, we met all of our targets, and if you just went for the first open magnetic whip, you would bank more than enough with this trade. Join me as I teach thousands of students how to trade like a professional. Learn how to trade the DR trading strategy combined with data, get access to exclusive tools and indicators, weekly live trading sessions where you also get deep market insights, which have never been taught in the retail space before, and a lot more. Visit m7er.com for more information. Number 3, Australian dollar versus US dollar, Tuesday overnight DR session trade. The trading day starts with a red ADR box, followed by a short confirmation and a nice short setup in the retirement setup area. Price respected the DR high and didn't close above it on a 5-minute time frame before continuing lower. It is then followed by a red ODR box with an immediate short confirmation, which is a very good sign. The earlier the confirmations happen, the better it is. One good setup would have been this one right here with obvious opening price rejections, but shortly after, price stops you out and presents you a beautiful retirement setup. A look at the Australian dollar futures market helps here. You get a clearer picture of the IDR high rejection with the bodies of the candle. This is your setup here with the stops above the DR high and the 1 SD level as a target. Now listen carefully. The ODR session is ending and your target hasn't been met yet. Where could you put your stop loss to reduce your risk or even into profit? Look at the futures chart giving you a clear intraday gap imbalance rejection before it's continuing lower. This one should restrict price and keep the next session from going above if a downside expansion model stays intact. That's a good reason to hold on to your target of 1 SD and move your stop into profits. With the opening of the regular DR session, we hit our target. Excellent trade and also management. Number 2, light crude oil futures market, Thursday regular DR session trade. The trading day starts with the ADR inside the previous RDR session, which means that we are in a range contraction model and price will be squeezed into one direction. The ADR confirms shorts and drops lower. The ODR finishes with a false DR session and takes out this significant low here. Again, I advise you to rewatch my old live sessions to have a better understanding of the range contraction model. This could be an early sign of the squeeze being done here. The RDR finally opens, and at first it looks like it is continuing a downside expansion model, but at the end of the first hour of the DR, we get a green DR box, which takes out all the ODR levels and screams for a range expansion model. It looks like the squeeze to the downside has been completed and price wants to go higher here with a range expansion model being formed. All eyes should be on the ADR highs and the standard deviation level of 1. Price returns back to the opening price here, but not only that. Look at this intraday gap imbalance, which has been created before the ODR session, acted as a support for it, then got broken with a false DR confirmation, acted as resistance at the opening of the RDR, then got broken again to the upside. With all the previous things said, what do you think is possible here? That's a valid entry with stops below the IDR mid. Very, very advanced, but I want you to understand how everything stacks up and makes this a valid and high probability trade. Price pushes higher and confirms longs. The ADR levels got also broken. What to do now? If you want to go for the 1SD in this range expansion model, look for reasons to enter. Here we have the ADR mid-level, the ADR lows, and also previous intraday gap imbalances probably acting as support now. Your stop goes 2 to 3 ticks below the IDR high to cover the intraday gap imbalance cluster. We have 2 open magnetic wibs here as well, but if price stops you out here, you can find an even better entry because you don't want price to go below the opening price and the intraday gap imbalance anymore. Very beautiful trading day. Hard to catch the advanced trade here as it requires some experience with the DR strategy, but the second trade is definitely one that can be executed. And here's number 1, Euro versus the Australian dollar again. Wednesday aftermarket DR session trade. Another banger ADR session in Euro AUD. Now before we start with this one right here, I can tell you that if the ADR confirms longs in the first hour after the box has formed, it will reach 3 SD with a 50% plus probability if the DR holds true and doesn't turn into a false session. If you want to be on the safer side, go for 2 SD or at least 3R. Who else gives you statistical information like this? Tell me. Now let's get into this ADR session here. We form a green DR box and return back into the opening price before continuing higher for the long confirmation. Looking to the left, we can see that not only the opening price supported here, but also the previous RDR high levels. The confirmation happened at 9:25 p.m. Price retraces back below the closing price and pushes higher with the next candle, which also rejects the IDR mid. That's your first entry. Your stop can go 2 to 3 pips below the retracement low. Obviously, if this setup fails, you can easily get another opportunity in the retirement setup area. Now with targets, let's be confident and aim for 3 standard deviations here, as data shows that it's very likely with more than 50% probability. Price goes higher and comes back to the closing price, giving several opportunities to enter here before it finds its way to 3 SD and even more. Last but not least, I want you to go into your chart and check all 5 ADR sessions from this week here in Euro versus the Australian dollar. Study how many standard deviations price moved after it confirmed into either direction between 8:30 and 9:30 p.m. and the session held true. How many possible trade setups can you find and how many of them would be successful if you aim for 2 or even 3 standard deviations? I guarantee that you will be surprised. Don't forget to like the video and leave some feedback. Have a great trading week and see you in the next video. We're gonna take on the world.